Okay, so moving on to chapter 3, I explained to you that there are some additional adjustments we have to make before we can prepare financial statements. So this goes back to the underlying framework of our GAAP is built upon the accrual basis of accounting. So we recognize revenue and expense based on revenue recognition criteria and expense recognition criteria. So accrual basis accounting is different from cash basis accounting. Okay, we do not simply determine our revenue and expenses based on when the cash transaction takes place. So instead, we determine when we will be able to recognize revenue based on when we fulfill our responsibility. Okay, once we completed our performance obligation, we provided our service or deliver our goods to our customers, already did everything we need to do to earn that revenue, we will be able to recognize revenue, even if we haven't received the cash yet. Okay, and then sometimes in some business, a company collect the payment from the customer first before they provide the service or deliver goods. And in this case, since we still have to follow revenue recognition criteria, so we have to postpone the recognition of revenue. So in this case, we say that we have to defer recognition of revenue until the future point of time when we provide a service or deliver the goods and then earn that revenue. We will make an adjusting entry to transfer the amount of revenue that we earn from the unearned revenue, which is the liability account we created originally when we collected the payments from customers, to revenue. Okay, so that's when we provide the service, deliver goods, completed our performance obligation. That's when we transfer that amount from the unearned revenue to recognize the revenue that we earn. So for expense, that's the theme. Okay, so we have the expense recognition criteria, let expense follow revenue. So we try to make sure that the expense that we incur are recognized in the same period when we recognize the revenue by using up the resources and incurred expense. So we try to match the expense with the revenue. So in the period when we recognize revenue, we'll try to recognize the expense, the cost that we incurred in the same period when we recognize revenue. Okay, including those resources that are being used up to support the generation of our revenue. Okay, we will make sure that we recorded cost of the use up of those resources in the same period when we recognize the revenue. Okay, so similar to revenue, okay, we do when we recognize the expense, we do not simply look at when cash transaction takes place. Okay, so when we paid out cash for a certain kind of expense, okay, if we already incurred expense, okay, we'll recognize expense. Okay, but if we haven't incurred expense yet and we already made the payment, then even though we have to reduce our cash, but on the debit side, instead of recognizing expense, we'll put it into a prepaid expense account, which is an asset account. And then for the amount of payment that we made in advance before the expense incur. And later on, when expense incur, we will then transfer that amount from prepaid expense to expense. And of course, for some kind of expense, if it's already incurred at the end of the period before prepare financial statements, but we haven't made the payment yet. So these kind of expense hasn't been recorded on our book yet, but we'll make an adjusting entry to record these accrued expense. And then on the credit side, we will credit a payable account instead of crediting cash, since we haven't paid out the cash for that expense yet. So we'll credit certain kind of payable amount account and then debit expense. And then when we make the payment, we will reduce our cash and then reduce the amount that we recorded in the payable account. After we prepare these adjusting entry, we'll again post them to ledger, get an updated balance for all our general ledger accounts, all the accounts in our general ledger. And then we can use that information to prepare our financial statement. Okay, and typically before we do that, we'll also have to prepare another trial balance to double check after we included these adjusting entry. Our total debit balance is still equal to the total credit balance across all accounts. This is just another way, this is one more check for to ensure that our accounting equations continue staying balanced, and then allow us to catch any some obvious error that we make in the reporting process when we report those adjusting entries. And then we'll use that adjusted trial balance to prepare financial statement. Okay, so at this stage, we talk about income statement, we know statement of retained earning, and then balance sheet. Okay, so statement of cash flow, as I mentioned at the beginning of this course, we'll talk about in the last chapter this semester. So therefore, at this point, you only have to know the basic structure of statement of cash flow. We know that a state cash flow is breakdown into operating, investing, and financing activities. And in this statement of cash flow, it allows us to explain the changes of a cash balance. Okay, but I'm not expecting you to use any information from trial balance to prepare a statement of cash flow, because we have a very special way to prepare a statement of cash flow, which we'll cover in the last chapter this semester. So at this point, you don't have to use, we don't use trial balance, okay, to prepare any, we use trial balance to prepare income statement, balance sheet, statement of retained earnings, but not cash flow, okay, not cash flow statement. Okay, so after we prepare financial statement, okay, move on to chapter 4. Okay, we talk about the last stage of our accounting cycle. Okay, there are some cleanup work we have to do in the closing process. Okay, we have to make the closing entry, including in total there are 4 of them, to close our temporary accounts. Okay, including all the income statement account, revenue expense account, and dividend account. Okay, so we'll prepare these closing entry, close out the temporary account. Okay, keep in mind only temporary account need to be closed out. Right, those permanent account, balance sheet account do not need to be closed out, because the balance of those permanent account will be carried forward to the next period, so they do not get closed out. Okay, so permanent balance sheet account, permanent accounts are not closed out. So we only close out the temporary account, and then through this closing process, we'll also be able to update our retained earnings balance. Okay, and then after we prepare these closing entry, post them to ledger again, update get an updated balance, we'll again prepare another trial balance. And this is something, the trial balance we prepare after we finish the closing process. So therefore, we call it a post-closing trial balance. So which is the last step, okay, that we see in the accounting cycle. So there's one more exercise that I'm going to walk you through, which is the exercise we have in chapter 4. So the last page of notes for chapter 4, okay. So here they give us this is an adjusted trial balance. So let me share my screen with you. Okay, so this is the adjusted trial balance of this company. Okay, for October 31st, 2022. Okay, that's to prepare a closing entry as of October 31st, 2022. So what we need to do is just make sure that we identify those temporary accounts, because only those temporary accounts needs to be closed out. So let's see what are those temporary accounts we have here. Cash is an asset account, which is a balance sheet account, permanent account, accounts receivable, asset account, balance sheet account. Okay, notes receivable, another asset account, balance sheet account. Supply is a balance sheet account, which is an asset account. Accounts payable is a liability account, still balance sheet account. Notes payable, liability account, that's a balance sheet account. Unearned revenue, this is a liability account, based on what we learned from the adjusting entry, okay. And then common stock, this is also this is a stockholders equity account, also a balance sheet account. Okay, so we have retained earnings. Of course, this is a balance sheet account, and then but through the adjusting entry, we'll update the retained earnings balance. Okay, currently what we have in our retained earnings is we have a 2,500. Keep in mind, retained earnings is stockholders equity account, so therefore the normal balance stay on the credit side. So retained earnings has a 2,500 credit balance. Okay, dividend account. Okay, this is a temporary account. Okay, these need to be closed out. And then we have revenue account. Okay, this is a income statement account, so this will need to be closed out. So this is an income statement account. Okay, insurance expense. Okay, this is another income statement account. Expense account needs to be closed out. Wage expense is this an expense account. Okay, so need to be closed out. So, okay, so let's start. Okay, so first we have to close our revenue account. Okay, so to close our revenue account, okay, we have to debit revenue. Okay, and then because revenue account carry a credit balance on the credit side. To close it out, we'll have to record the same amount on the opposite side. So we'll debit revenue 3,000, and then we'll transfer this amount to income summary. So we'll credit income summary 3,000. Okay, and then in the second closing entry, okay, we have to close out expense account. So since expense account, okay, we have two of them. Expense account carry a no balance on the debit side. So to close it out, we will credit insurance expense for 1,000, and then credit wage expense for 500. Oh, and then on the debit side, we'll debit this amount to income summary, 1,500. Okay, and then after we close out all these revenue expense account to income summary, so you can just draft the income summary T account, and then just put in this amount and then double check. Okay, currently our income summary, because once we close our revenue expense account, total revenue 3,000, total expense 1,500. So currently our income summary carry a 1,500 credit balance. So to close out this income summary account, we'll record the same amount in the opposite side. So we'll close out. So we'll debit income summary for 1,500. Okay, and then this income summary, this is the net income that we generate this period, and then we will transfer this amount to our retained earnings. Okay, by doing that, we basically include our retained earnings balance. Okay, we include our retained 1,000 credit, transfer this net income into our retained earnings to obtain its balance. So we credit retained earnings for 1,500. Okay, after the third closing entry. Okay, and then finally the last closing entry. Okay, we'll close out the final temporary account we have. Here we have dividend 500. Dividend is a debit balance account. So to close it out, we'll credit dividend for 500. And then debit side will debit retained earnings for 500. Okay, so we'll debit retained earnings 500. Okay, and once we include this retained earnings, okay, so 2,500 and then adding 1,500, which is the net income, and then we will debit retained earnings 500. So we'll debit our retained earnings for the dividend that we declare and pay this period 500. So therefore, retained earnings balance is being reduced by 500. So 2,500 plus 1,500, and then subtract out 500. So therefore, our retained earnings has a balance 3,500. Okay, so once we complete this closing process, okay, we close out those temporary accounts that we have on the rest revenue expense account, and at the same time, we will update our retained earnings. Okay, so we close out those revenue expense and also dividend account. These are temporary account, and then through this closing entry, we also update our retained earnings balance to its ending balance 3,500. So this is what we expect to see in our statement of retained earnings and also in the balance sheet. Okay,